Most people think wealth needs a big starting point, a big salary, a big opportunity. But that belief is exactly what keeps them stuck. Because wealth does not begin with big money. It begins with small decisions. 500 rupees, 1000 rupees, 2000 rupees every month. That's where it starts. But here's the problem. Small numbers feel insignificant. They don't impress. They don't excite. So people ignore them. They wait for more income, for more clarity, for the right time. But in investing, waiting is expensive because time is the real multiplier, not effort, not intelligence, just time and consistency. And those who understand this early end up building something most people never do. Quiet wealth. No shortcuts, no noise, just steady growth. Let's break this down, step by step. This video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Step 1. Start small but remove delay. Starting small is not the problem. Delaying is. Example. Person A starts investing 2000 rupees at age 22. Person B starts investing 5000 rupees at age 32. Person B invests more but starts late. After 30 years, person A still ends up with more wealth because time worked longer. This is the unfair advantage. Early action beats higher contribution. So don't wait for comfort. Start with what you have. Step 2. Build the habit before chasing returns. Most beginners focus on returns, but returns come later. First, you need habit. Investing must become automatic, like paying a bill. No thinking, no decision fatigue. Example. Set auto debit SIP of rupees 3000, same date every month. Even if market falls, even if news is negative, you continue. Because habit creates discipline, and discipline creates results. Step 3. Understand SIP deeply. SIP is not just convenience, it is a behavioral tool. It protects you from yourself. Markets go through cycles, up, down, sideways. When you invest regularly, you average out costs. Example, month 1, market high, you get fewer units. Month 2, market falls, you get more units. Over time, your average cost becomes efficient. This reduces risk and removes emotional timing. That's the real power of SIP.
Step 4. Choose the right investment vehicles. Not all investments are equal. As a beginner, keep it simple. Index funds, large cap mutual funds. These follow the overall market. Low cost, less complexity. Avoid jumping into random stocks. Without knowledge, it becomes speculation. Focus on consistency, not excitement. Step 5. Asset allocation. Control risk before chasing growth. Returns attract attention. Risk destroys portfolios. Balance matters. Simple model. Equity 60%, debt 30%, gold 10%. Equity grows wealth. Debt protects capital. Gold hedges uncertainty. Example, 10,000 rupees monthly investment, 6,000 equity, 3,000 debt, 1,000 gold. This structure keeps you stable, even during market shocks. Step 6. Respect market volatility. Markets will fall. This is not a possibility. It is a certainty. Sometimes 10%, sometimes 20%, sometimes more. Example, your 8 lakh portfolio can drop to 6.5 lakh. That moment tests you. Beginners panic. They stop investing, or worse, they exit. But experienced investors stay calm because they expect volatility and they use it. Lower prices mean better long-term returns. Step 7. Rebalancing keeps your system aligned. Over time, your allocation changes. Equity grows faster. so your risk increases silently. Rebalancing fixes this. Example, your equity becomes 75%. You sell a portion, shift to debt or gold. Now back to 60%. This locks profits, reduces risk. Do this yearly. Simple discipline. Step 8. Understand basic taxation. What you earn is not what you keep. Taxes matter. Equity investments, held more than 1 year, have long-term capital gains tax, above 1 lakh, taxed at 10%. Short-term gains taxed higher. Use ELSS funds. They give tax deduction under Section 80C. Plan taxes early, not at the end. Step 9. Avoid behavioral mistakes. Mistakes are expensive, and most are emotional. Mistake 1. Trying to time the market. Mistake 2. Stopping SIP during downturns. Mistake 3. Switching funds frequently. Mistake 4. Following trends blindly. Mistake 5. Expecting quick results. Wealth is slow. Respect that pace. Step 10. Increase investments as income grows. This is where real acceleration happens. Your income will rise, but if your investments stay same, growth slows. Use step-up strategy. Example, start with 4,000 rupees SIP. Increase by 10% every year. After 10 years, your monthly investment becomes significant. This boosts compounding massively. Step 11. Build emergency safety before aggressive investing. Before chasing returns, secure your base. Keep 3 to 6 months' expenses in liquid funds or savings. This prevents forced withdrawals during emergencies. Without this, even good investments fail. Step 12. Stay invested for the long term. Time in the market beats timing the market. 10 years? Good. 20 years? Better. 30 years? Powerful. Compounding needs time. Cutting it short reduces its effect. Stay patient. Step 13. Track, but don't obsess. Review your portfolio once every few months, not daily. Daily tracking creates anxiety and leads to poor decisions. Focus on process, not short-term value. Step 14. Build multiple streams slowly. Investments are one part. Income growth is another. Increase skills. Increase earning capacity. More income means more investments, which means faster wealth creation. Step 15. Consistency beats intensity. You don't need to invest huge amounts suddenly. You need steady contributions, month after month, year after year. That's what builds wealth. Not one-time effort, but repeated discipline. Wealth does not announce itself. It builds quietly, in the background, through small actions, repeated consistently. Years from now, you won't remember every investment, but you will see the result, and your future self will thank you for starting early. Not perfectly, but consistently. Start small, stay disciplined, and let time do the heavy lifting.